Have you ever wondered why some people struggle to grow their wealth despite investing? The truth is, it's not always about the amount you invest. It's about the mistakes you make along the way. Let's watch the top 10 investing mistakes that keep you poor and how you can avoid them. But before we begin, make sure to like this video and subscribe to our channel to watch more videos like this. Number 10. Failing to diversify your investments. Have you ever heard of the saying, don't put all your eggs in one basket? It might sound cliche, but when it comes to investing, it's sound advice. The first mistake that could be keeping you poor is failing to diversify your investments. Placing all your money into a single stock or asset might seem like a smart choice when it's performing well, but what happens when it falls? The truth is, the market is unpredictable, and relying on just one investment can expose you to unnecessary risks. If that stock, bond, or asset takes a downturn, you could lose a significant portion of your money. By diversifying across different assets like stocks, bonds, real estate, or mutual funds, you can reduce the risks and potentially increase the chances of long-term growth. Number 9. Letting emotions drive your investment decisions. How often have you let fear or greed influence your investing choices? When the market fluctuates wildly, it can be tempting to make impulsive decisions. The problem with emotional investing is that it leads to rash decisions like selling off assets during a market dip or rushing to buy into a hot trend. In 2025, emotional reactions to market shifts can still create chaos for investors. For example, during market crashes, panic sets in, leading people to sell off their holdings, often at a loss. On the flip side, when the market is soaring, many investors can't resist the urge to jump on the bandwagon and invest in something they haven't fully researched. What's the solution? You need a disciplined, long-term approach to investing. Number 8. Overlooking the power of compound interest. Have you ever thought about how your money can grow on its own? Compound interest is one of the most powerful tools that can work in your favor, yet many investors overlook its potential. Imagine a snowball rolling down a hill. What starts small becomes bigger and bigger over time. This is how compound interest works. When you invest, your money generates earnings, and those earnings start generating more earnings. The more time your investments have to compound, the more your wealth will grow. However, many people fail to take advantage of this because they either don't invest early enough or they don't reinvest their returns. Number 7. Chasing the latest trends and hot tips. Have you ever gotten excited by a hot tip or the latest investment trend? It's easy to get caught up in the excitement when everyone around you is talking about the next big thing. Whether it's a hot stock or a new cryptocurrency, jumping into investments without fully understanding them is a common mistake, and it can keep you poor. In 2025, the market is full of trends that come and go. People rush to buy into something because of its recent surge, only to see the value drop just as quickly. If you're chasing the latest trend without conducting proper research, you're gambling with your money. Instead of following the crowd, take a step back and evaluate whether a trend aligns with your investment goals and values. Number 6. Ignoring fees and expenses. Have you ever checked how much you're paying in investment fees? Many investors overlook the impact of fees, but they can quietly drain your returns over time. Whether it's management fees, trading commissions, or advisor fees, these charges can add up quickly and reduce your profits. In 2025, with the rise of low-cost ETFs and commission-free trading platforms, there's no excuse for not being mindful of fees. While a small fee might seem insignificant in the short term, over years and decades, they can eat away at a substantial portion of your returns. So, what can you do? Make sure to read the fine print. Opt for low-cost index funds and be conscious of any fees you're paying. The less you spend on fees, the more of your returns you'll keep, helping you grow your wealth faster. Number 5. Trying to time the market. Do you believe that you can predict when the market will go up or down? Many investors think they can outsmart the market by buying at the right time and selling before the market dips. But trying to time the market is one of the biggest mistakes investors make. The truth is, no one can predict the market's movements with perfect accuracy. Even professional investors and fund managers have a hard time getting it right. When you try to time the market, you're more likely to miss out on gains or sell too early, locking in losses. Rather than trying to time the market, consider adopting a long-term investment strategy. Number 4. Not having a clear investment plan. Do you know exactly why you're investing and what your financial goals are? A common mistake that keeps many people poor is investing without a clear plan or strategy. When you don't have a roadmap for your investments, you end up making decisions based on emotion or short-term market movements instead of focusing on your long-term goals. In 2025, successful investors understand the importance of having a clear, actionable plan. Whether you're saving for retirement, a down payment on a home, or another financial goal, your investment strategy should be aligned with your objectives. Without a plan, it's easy to get distracted by the noise of the market and lose sight of what you're working toward. Create a strategy that fits your goals, risk tolerance, and time horizon. Number 3. Relying too much on employer-sponsored retirement plans. Do you think that your 401k will be enough to support you in retirement? Many people assume that their employer-sponsored retirement plan will be the primary source of their retirement income, but this can be a major mistake. These plans alone may not provide the lifestyle you desire when you retire, especially if you're not contributing enough or the investments aren't diversified. In 2025, more people are realizing that they need to supplement their 401k with other investments such as an IRA, taxable brokerage accounts, or real estate. Relying solely on your employer's retirement plan can limit your wealth building potential and leave you at risk of falling short in retirement. Number 2, ignoring inflation's impact on your investments. Have you thought about how inflation can erode the value of your money over time? Inflation is a silent thief that quietly reduces your purchasing power, and if your investments aren't growing fast enough to outpace inflation, you're losing money without even realizing it. In 2025, with inflation continuing to impact the global economy, it's crucial to make sure your investments are protected. If you're only relying on low-yield bonds or savings accounts, your wealth could be stagnating while inflation eats away at your purchasing power. To protect yourself from inflation, invest in assets that tend to outperform it, such as stocks, real estate, or inflation-protected securities. Be mindful of how inflation affects your portfolio and adjust your strategy to stay ahead of it. Number 1, not starting early enough. Have you been putting off investing because you think it's too late to start? The biggest mistake you can make as an investor is waiting to start. Time is the most powerful factor when it comes to building wealth, and the earlier you start, the more time you give your money to grow. In 2025, many people are still waiting for the perfect time to invest, only to find that the perfect time never comes. The longer you wait to invest, the more money you miss out on. Even small amounts invested regularly can add up over time, thanks to the power of compound interest. So don't wait any longer. Start today, no matter how small your investment is. The sooner you begin, the greater your chances of financial success. Time is your most valuable asset. Use it wisely. So which of these mistakes have you been guilty of? Let us know in the comments, and if you found this video valuable, make sure to like, share, and subscribe for more tips and strategies to achieve your financial goals.